Hey guys, today I'm going to talk about how to not blow up your evaluation account. Um, and this is a video I made based on just trial and error myself of learning how to not blow up accounts during these trader evaluations. So you might be taking an evaluation with Elite Trader Funding, Apex, Topstep, Takeprofit, LeeLoo. There's a bunch of them, and they're all pretty similar in that they give you a profit target as well as a drawdown that you cannot hit or else you fail. And basically, I hope this video saves you some money on reset fees or on subscription fees. Most of them, once you pass, you get either a reduced monthly data fee or you have no fee at all after you're funded. So, my first tip for traders taking trader evaluation program is to not rush it. There's no prize for completing it sooner. So if you hit your profit target on day one, there's not going to be any special prize or perk that you get for doing that. In fact, you're going to have to still wait out the minimum trading days requirement for most programs, and you're going to get the same funded account as everybody else. So I would tell you to pace yourself and to not feel the need or pressure to hit your profit target on day one or day two. Like, of course, it's possible, but you don't have to aim for it. Like, you can just try to trade consistently. Um, the goal, I think, for traders taking these programs should be the ability to generate profit in a consistent manner. And I think by kind of pacing yourself, you're kind of forcing yourself to learn how to trade in different market conditions, and that serves you the best in the long term rather than trying to make a very large play and make a bunch of money in one day. Like, that doesn't really teach you very much. So I think you're better off just pacing yourself and learning how to trade consistently. That to me is a more valuable skill than getting lucky. um, Another thing about when you try to rush it, that's a very easy way to blow up your account, because you're often forced to take excessive risk to get large returns. I've seen some companies offer fast track evaluations where you can get funded in as little as 5 days, and the max is 14 days on the evaluations. I don't recommend this to traders unless you have a strategy, you're consistent, you know what you're doing. Sure, but if you're not, I don't recommend a fast track plan to anybody, because it just puts this additional pressure on you to take trades that are typically higher risk, and also just knowing the pressure that if you don't hit the target, you have to reset or try again. Um, I think a month is a pretty reasonable amount of time to try to hit a profit target. And I know, even like, let's say you don't do a fast track program, you still are able to get an account funded in some companies as minimum as like 7 days or 5 days or maybe 10 trading days, but that's still not that bad. Like, 2 weeks isn't terrible. So I think you're better off trying to take your time and not try to hit your profit target in a short period of time. And also, the plans that offer fast track typically have higher profit targets and lower drawdowns, where it's almost like it's made for you to fail. And they'll throw in like you know so-called free perks. Like, if you pass it on the fast track plan, you might get a free month of data. I think it's to get you. It's a trap, and it's almost like a lottery ticket. I don't recommend those kind of evaluations. Second, I would say use an appropriate lot size based on your account size. So if you're constantly blowing up your evaluation accounts, maybe you're trading too big. Instead of trading two minis, try trading one. Instead of trading one mini, try trading micros, and kind of get a feel for what works best for your account. Um, there's no one size that fits all. I've heard people say they only trade minis, or they only trade micros, and I think each trader needs to determine what's most appropriate for him or her. A lot of people that tell you not to trade micros have accounts of $300,000, so they're able to really stomach large swings in the market easier because their drawdown could be $8,000, $10,000. If you have a $1,500 drawdown, I don't think you should be trading two minis, right? So find a position size that allows you to sleep at night. So if you're trading one micro and you feel like you're missing out on money, okay, scale up, right? But if you're trading 4 minis and you're blowing up your account the first day every time, maybe you should go down to 1 mini or micros. And another thing I would say is consider how many points it would take to blow up your account if a trade moved against you. So an example I'm going to give you is if you have a $1,500 drawdown and you're trading one E-mini on the ES, a trade moves 30 points against you and your account's blown up. And if you double the position size to 2, it now becomes 15 points. The ES moves 15 points on average. Like that's not that unheard of. So, versus trading, let's say 2 micros, it would have to move like, what, 1,500, 150 points. And I think that's a little better. You have a lot more wiggle room that way. So when you're trading, just consider how many points could a trade move against you before your account blows up. And I think this could help you kind of pick a position size that works best for your account. Because your drawdown. Like my account size is not your account size, and my trading style is not your trading style. So it's something to consider when you're trading, because I think it could help you just find out what works best for you. Another thing I would say is to be very careful when dollar cost averaging or doubling down on losing positions. So the benefit of doubling down or dollar cost averaging is, let's say you bought a position and then the trade goes against you. That kind of means that the position is now a lot cheaper. And if you buy in a second position, it can lower your unit cost for each unit. This is risky because in reducing your costs, you're doubling your risk, or you're increasing your risk. So I'd say just be very careful when dollar cost averaging, because with these trading evaluations, you're being graded as a day trader. You're not holding long term. So this is not like Apple stock goes from 150 to 100. So I'm gonna buy, more shares at $100 to get my new unit cost per share at 125. Therefore, I'm better off when Apple goes back to 125. Right? That's a long-term play. If you're trading stocks or even options, you have time for your play to play out. With day trading or trading futures, you're making plays based on the day. So you might double down on a position that's a loser, and it might continue to go against you. And now you have a lot less wiggle room to break even or even get profitable. And it's also an easy way to blow your account up. If you double your risk and the trade keeps moving against you, your account's going to blow up much quicker. The market can be very unpredictable in the short term. Dollar cost averaging increases your lot size and could easily make a bad situation even worse, because it increases your position size and reduces your margin of error. This only works as a strategy if you double down on a loser and the trade reverses and goes in your favor. If it doesn't do that, you're actually now worse off than you were in the beginning. And psychologically, doubling down on losers, it increases your commitment to the position, and it really increases your need for the trade to reverse. It just creates this desperation in the trader to like, please work out, or please don't keep going. And I just think it's a really easy way to blow up an account. I don't recommend dollar cost averaging. Unless it's part of your strategy and you have a way to manage the risk, but I don't recommend it as something that most traders should be doing, especially on evaluation account. So this one's something that took me a while to figure out, which is don't overtrade. Plan your work and work your plan. Before the trading day, you should have an idea of what you hope to achieve in the market. You should have a plan to enter positions and a plan to exit positions. We are short-term traders, so we're not buying and holding here. This is trading. You're buying and you're selling. Over trading increases your commission costs and it exposes you to additional risk. So you could be having a great day, you're up and you keep trading, and then the market goes against you and then you lost everything you made. It's not worth it a lot of times. Like if you hit your goal for the day, you're satisfied, take some time off, take a break. And I think over trading is just a very easy way to turn a winning day into a losing day. So this one's very important. I'm sure everyone says this about trading, but your emotions really impact you as a trader. And I can't state this enough, like how important it is to be able to manage your emotions. Your emotions can work against you in many different ways. It can, let's say you're having a great day, you can be overconfident. Then you start taking riskier trades based on your overconfidence, and then your account blows up. Or you could be angry and frustrated because the market's not doing what you think it should be doing, and then that forces you to continue to kind of double down on a bad trade because you're trying to prove the market wrong. Or you could be fearful about you're taking profit too soon because you're afraid of losing profit, or you're not taking positions that you should be taking because you're afraid, or greed, where you're making so much money you start focusing more on this target in mind, where if I can make 10,000 in a day, and then you start risking lots of money to hit that goal, and then it blows up. Or just even having doubt, like second guessing yourself, where you're right, your strategy's sound, and you're doubting yourself, and then you kind of let an opportunity pass up because you're not confident in what you're doing. So I think it's important to be able to name your emotions and also have a plan for how you deal with them. For me, sometimes it just means taking a break from my computer, closing everything, eating a meal, going for a drive, or wait until the next day. It's really hard sometimes once you get so like involved or deeply invested in the market emotionally. I just don't see much coming from it in a positive way. For me, I think it's been more negative than positive when it comes from trading on emotions, whether it's trading on a high or trading from a low. So I just think it's important to be aware of how your emotions affect your trading specifically, and develop a plan to keep your emotions in check. Also, this is more of like a manual option. You actually can create your own risk parameters. If you're using a platform or a trading evaluation company that works with NinjaTrader or Rhythmic, you can actually go into Rhythmic and create your own risk parameters. I can make a video on that as well if a lot of you don't know how to do it. But basically, you go into your Rhythmic account, you right click on your account, and there's an option where it says open like risk parameters. And from there, you're going to see three tabs, which is one tab from like the company you're working with, one from the broker, and there's one that says trader. And you can actually go in there and create your own like loss limit for the day. So let's say your account has a $3,000 drawdown. You can actually go and Rhythmic yourself and give yourself like a $2,000 limit where it'll close you out for the day and you can't trade till the next session. This could work for some traders, like if you just need that extra level of protection where you won't blow your account up. I think it could help. And I will just say though, doing that might force you to open the next session and start trading with the $1,000 drawdown. Like there are instances where I think you're better off just doing a full reset and getting back your full drawdown. Like if you have an account where you have a $3,000 drawdown and you stopped out at 2,800, just know you now have a $200 drawdown, and it's going to be a long way upward to get back to where you were before. So in some cases, I think you're better off just blowing up an account. But there's also precautions you can take to avoid it getting that far. And I think it's up to each trader to figure out what's better off for them. If you're better off resetting your account, or if you're better off, just trading through it, right? You get out of the position before it blows up and trade your way back to where you were before it blew up. So I hope these tips help you guys. If you have any questions, just leave it in the comments, and I can make videos sharing any other information you guys want to see on my channel. Thanks for watching.